Hey you guys, welcome back to the show. My name is Brad. This is Firefighter's Financial Toolbox. Today we're going to talk about inflation because that seems to be like the buzzword what's going on right now. And it is a concern. As we know, a lot of things are going up. If you're trying to build a house lately and you're looking at lumber prices like I am, holy crapola. Inflation is there. If we look back to what gas prices were last summer, they were in the tank. Now they're catching up. Not all factors of our life has been inflated in prices, but things are going up. And the Fed is actually talking now about raising the rate. So inflation is important. Why is it important to us? Because it eats away at the value of the money that we have. So we're going to talk about 6 ways to brace your investments or inflation-proof your investments. Inflation presents special challenges for investors. Even if your investments are growing in value, inflation is still reducing that value on the back end. The only way to deal with it successfully is to be sure your money is in investments that are likely to benefit from inflation, while avoiding those that tend to be especially hard hit. So how do you do that? How do you find these investments that benefit from inflation instead of losing their value? Here are 6 inflation-proof investments to consider. All right, so why might inflation be a problem? The economy is flashing signs of deflation, particularly with rapid decline in oil prices. And businesses are reducing staff or shutting down to limit the spread of the coronavirus. This is a little bit old, but things tend to take a sudden change. Fear of an economic downturn of major proportions is causing the government and the Fed to do what they can to inject liquidity into the economy and financial markets. Inflation of the US dollar is a definite possibility, though it may seem improbable right now, as trillions of dollars of new money enter the economy. After all, the main purpose of liquidity injections is to prop up the financial asset values and get money in the hands of consumers. You guys, they're printing money so that we'll have money to spend. They're afraid if nobody has any money, all the spending will stop. But guess what? All of these stimulus checks, most people have either invested them or held on to them. All right, the purpose to prevent additional carnage in the financial markets and to mitigate a widely expected decline in the economy, which is always, they learned this in 2008, right? So, inflation-proof investments worth considering. There are no guarantees when it comes to investing for inflation. So, first of all, no, nothing is certain. These are just ideas. At best, certain investments may be inflation safe, but returns can never be guaranteed. This is especially true in the rapidly evolving coronavirus-driven financial environment we're now in. Certainly, if employment continues to decline and consumption with it, a deflationary trend will prevail. Let's look at when this was written. This was written in May of this year, you guys. So, if it would have been last year, I would have understood it. Okay, well, let's keep going. Keep cash in money market funds or tips. If you suspect that inflation will be a factor, it's best to keep any cash type investments in money market funds or high interest cash accounts. While it's true that money markets certainly pay next to nothing, they're cash investment of choice during periods of rising inflation. Here are 2 reasons why this is true. I'm curious about this because cash isn't paying anything. Because the rates they pay fluctuate continuously with interest rates, and they automatically adjust upwards as interest rates rise. There's no need to chase higher yield cash type investments. Since money market interest rates rise with the general market, you won't have to face the loss of market value that plagues fixed rate investments during times of inflation. So, as we know, when inflation goes up, the bond price goes down, we lose money. Okay, so when inflation hits, money market funds are interest-bearing investments, and that's where you need to have your cash parked. Still, another alternative is Treasury inflation-protected securities, or TIPS. And these are only issued by the U.S. Treasury. You can buy them online through Treasury Direct, denominations as small as $100. And it goes into how to do that. If you guys are interested, I'll put a link for Treasury Direct, and you can look into how it is. Tips are actually quite complicated. Here are the basics of tips. They can be purchased in multiples of $100. They're available in terms of 5, 10, and 30 years, which means they're longer-term securities. Tips are designed to adjust for inflation. Tips pay regular interest and make annual adjustments up or down to the principal based on the CPI. If the CPI drops, your principal will be reduced, but the tips held to maturity will pay at least their face value. So kind of like a bond, you guys. If we have a deflationary period, the value of your tips will go down. But if it goes up, it will be increased by the amount of the inflation. All right. The bonds are available in terms of 5, 10, and 30 years and pay interest twice annually. Each year, the value is adjusted based on the CPI. This gives you regular interest income plus an annual adjustment for inflation to your principal value. All right. Number 2, inflation is usually kind to real estate. Over long-term, real estate is also usually an excellent investment in response to inflation. It actually is the ultimate hard asset and often sees its greatest price appreciation during periods of high inflation. This is especially true because as rents rise, people become increasingly interested in owning as a way of getting the tax benefits that help offset the general level of inflation. Now, you can either invest in residential properties, commercial properties, or you can buy them as a REIT. And we've talked about REITs a lot on my channel, you guys. I don't own any personal hard real estate other than my private home, but I own a lot of REITs. So REITs can be a good thing in inflation. Number 3, avoid long-term fixed income investments. You guys, long-term bonds. The longer the term of the bond, the more it gets affected by an interest rate. So, if you have a 3% bond and the the inflation goes up 1%, you lose basically 1% on the value of your bond. So this is a bad time to hold long-term bonds. If you're going to hold anything, go with shorter-term bonds, you guys. Now, I'm not telling you what to do. I'm saying, remember, first of all, bonds aren't paying very well. But bonds aren't designed to pay you well. They're designed as stability against a falling equity market. So I feel like as you get closer to your retirement age, you should have some bonds. I personally hold about 25% in bonds right now, and I'm 52. But I'm trying to hold shorter term bonds so they're not as affected by a rise in inflation. All right, number 4, emphasize growth in equity investments. Many investors try to balance out their equity portfolios by investing in high dividend paying stocks or in growth and income funds. And this can work especially well during periods of price stability. But when inflation accelerates, it can hurt your investment returns. This is at least in part because high dividend paying stocks are negatively affected by rising inflation in much the same way long-term bonds are. Now, this is true in the price of the asset. But you guys, a lot of times, even when inflation is going up, dividend stocks are paying their dividends. So let's read the whole thing. The better alternative is to invest primarily in growth type stocks and those funds. You should also emphasize sectors that are likely to benefit from inflation. These can include energy, food, healthcare, building materials, and technology. That I agree with. I think during times of inflation, the different sectors are certainly affected differently. Tech stocks are still there, but not the powerhouse they are when inflation is not there because they don't grow as fast. Since all are likely to rise in price with inflation, they're likely to perform better than other equity sectors. You can invest in these sectors through an ETF fund, or you can buy specific stocks that hold growth potential. So you guys, for most people, I say buy an ETF, buy an index fund. I think you're just as well off buying an S&P 500 total stock market index. If you want to specialize and get an index fund that's got a couple of those, that's okay, but don't make it your primary holding because times change. Inflation comes and goes, all right? Okay, number 5, commodities tend to shine during periods of inflation. While there isn't an exact correlation between price levels and commodities, Certain hard assets have traditionally been favored by inflation. Precious metals, for example, gold and silver, come to mind, right? Now, you can hold those in direct form, or you can buy ETFs. You can also invest in gold mining stocks or funds comprised of these kind of stocks. However, these stocks are not the actual metal itself, and they also tend to be extremely volatile, even during times when gold prices are rising. A more predictable hold on stock side will be energy stocks and those kind of funds. This is especially important during rising. All right, number 6. Convert adjustable rate debt to fixed rate. So, as we were talking about before, you guys, technically speaking, this is not an investment, but it could be one of the most profitable strategies that you make in response to inflation. Periods of low or declining inflation favor adjustable rates over fixed rates because you can get it going down. But when it comes up, you guys, remember, as that rate comes up, you're going to have to pay more. Higher inflation results in higher interest rates, which means that as inflation accelerates, your rates will continue to rise. If you believe inflation is coming, get rid of the adjustable rate debt and switch it to fixed rate. So if you have a adjustable rate mortgage, this is where most of this comes in, right? You guys, why rates are down at 3%, just get a 30-year fixed mortgage. Even if you prepay it, that's great. But don't rely on that. Because if it's adjustable, as interest goes, as inflation increases, the rate goes up, you're going to pay more. You're going to feel it. Don't do it. I am not a fan of adjustable rate mortgages or adjustable rate debt, period. Everybody's situation is different. This is my opinion. All right, so prepping your portfolio for inflation. As governments around the world struggle to flatten the curve of the coronavirus pandemic and stocks have faltered, it's clear that there will be an impact on the global economy. How severe is uncertain at the moment. Inflation could very well increase as the Fed eases its monetary policy. Low rates you're enjoying right now could evaporate in a matter of months, raising your cost of living. Converting them into fixed rate debt now is one of the best ways you can protect your cash flow. Repositioning is important if you think inflation is coming. This is especially true because inflation has been low or declining for the past 3 decades. But if there's a change in direction, it can be quite dramatic. Any steps you take can take to prepare in advance will pay off handsomely, especially over the long term. You guys, now I'm not saying inflation is going to happen for certain, but there's a lot of factors out there pointing to the fact that it could. So if it does, these are 6 ways that you can help yourself invest and save more money for the long term so that you can have a better retirement and be financially fit. I hope you guys got something out of this. If you did, do me a favor. Drop me that like. It really, really helps the algorithm. People, if you're not already subscribed, you know the deal. Hit the red button, ring the bell. You get notified every time I make a video. All right, we'll see you. Thanks.